So in this video, I'm going to share 7 strategies that I use to turn less than the cost of a college tuition into well over $1 million by the time I was 30. Now you might be sitting there feeling overwhelmed, right? How do I make money in business or online? Or maybe you just don't know even where to get it started when it comes to investing. I'm not here to give you a fantasy that $1 million is going to fall in your lap, although wouldn't that be nice? But what I can give you is some hope and confidence that you can do it with the right approach, hard work, and yes, a decent amount of luck. Now, the reality is there's way more ways to make money than ever before. It's insane. Stocks, crypto, NFTs, collectibles, freelancing, Facebook Marketplace, Etsy, Amazon. Confused yet? Yeah, don't worry, you're meant to be. The world is a more complex place than it's ever been, which means there's more opportunities than ever before too, if you know where to look. But seriously, imagine for a second being able to turn $10,000 into $1 million in just a decade. If you're in your 20s, a decade might feel like forever, but trust me, it's a blip in time. Whoa, hang on, Mike. What if I don't have any money to start with? Maybe you just don't know the first thing about investing. Look, stick around to the end of the video. I'm going to share some bonus tips on how to build up your first stash of cash when you have very little to start with. Okay, so let's dive in. Strategy number 1, start a business or a side hustle. Look, everyone's got a baseline of expenses that you need to cover in order to fund your lifestyle. When you're starting out, of course, you really want to eat shit. Well, not literally, that would be terrible, but you get what I mean, before ratcheting up your lifestyle. Now, starting your own business is the fastest way to make some extra cash, right? Every dollar that you make above your baseline expenses can be deployed straight into investments. So making an extra $500 or $1,000 or $5,000 or even $10,000 per month that you could put straight into investments changes the game for your returns. For example, if you started with $10K today and you invested in an additional $1,000 per month for the next 10 years, assuming a 7% average return, you'd have $168,000. If you could invest an extra $5,000 per month, you'd have $780,000. An extra $10,000 a month would turn into a whopping $1.54 million. Now look, obviously making an extra $10,000 per month above your baseline isn't easy for most people. If you want to watch my video on how I made $100,000 in my first 5 months of business, you can check it out in the description as well. Now, adding more income isn't the only way to hit your number, but it makes a huge difference. Not only that, but having a business can also help you shelter a lot of money from taxes and after-tax expenses that being an employee just simply can't, right? So we'll do more on saving tax and structuring a little bit later on. Strategy number 2, leveraged investing. This is huge. Years ago, I had this insight that just totally changed my perspective on investing forever. So when I bought my first piece of real estate in 2007, which, side note, about the worst time you could buy at the height of the boom before the 2008 financial crisis. So that was a pretty dumb move on my part. So I had about $50,000 of capital to invest, and I explored lots of different options of where to put it. There was the stock market, there was bonds, there was mutual funds, ETFs, options, you name it. But when it came around to assessing real estate, something kind of clicked in my mind. Real estate was the one asset class that allowed me to 5x or even 10x my capital base through a mortgage, which at the time was relatively easy to acquire with minimal risk by comparison to, say, margin investing on the stock market. Now, why is it so powerful? Well, because in the words of Kevin O'Leary, real estate is the one asset class that never goes to zero. So after crunching some numbers, it dawned on me that even if this one investment performed half as well, produced a quarter of the returns that other asset classes would, because that return was leveraged on a much higher asset base, it would still outperform everything else in absolute dollar terms. So this one realization made me double down on real estate as my first main play. Now, even making a bad buy at a bad time like I did still produced more cash when I sold it years later than if I had put the house deposit straight into the stock market, for example. Which brings me to strategy number 3, which is asset allocation is key. One of Warren Buffett's mentors was a guy called Benjamin Graham, and he wrote this seminal book on investing, which is still an incredible book today, called The Intelligent Investor. Right? It was packed full of insights, but one of the biggest takeaways I had from this book was that asset allocation trumps almost everything. Well, you've probably heard of the term diversification before. Now, asset allocation refers to how you're diversified or allocated across classes. So for example, asset allocation is the decision on how to allocate across categories like equities and bonds and cash and real estate, crypto, or any other type of asset you can imagine. Now, the reason this is so important is because of the correlations in risk returns between these classes. So for example, right, it doesn't matter how well diversified your equities portfolio is, if the whole market tanks, your whole portfolio is going to tank too. Whereas when equities is down, it's quite likely that another asset class like real estate or bonds or commodities such as gold is up. Now, these are what we call negative correlations between classes. It's what helps minimize overall risk and maximize return. That's just a bunch of fancy speak for saying you get minimum downside for losing your money while maximum upside making money. Now, look, the truth is, in the beginning, when you don't have much capital to play with, it's hard to allocate across many asset classes. It's quite likely, like me, that you put all of your capital into one class like real estate. Then once you've had a first win and you have more money to play with, you have more flexibility, which allows you to allocate across more classes. So in the beginning, don't be afraid to pick maybe 1, 2, or even max 3 asset classes and just go all in. So what I recommend is focus on the class that you know best. It's the one you've got the deepest insight in, you've done the most research, and then diversify across more classes over time. Strategy number 4, diversification within classes. First and foremost, you don't need to hold hundreds of stocks to be diversified in equities, for example, right? You might need 10, 20 companies across various industries and you'll get enough diversification to hit the 80-20 of really what you need. But look, let's just say you've got 50 grand to put into equities. Forget trying to pick individual winners. By strategically putting that money into 10 to 20 companies, you've researched, you think you're going to be the next big thing, chances are they won't. Because it turns out that even the most experienced institutional active fund managers who get paid big bucks to pick winning companies still underperform the market over long run horizon. For example, 93.4% of all large cap mutual funds in the US underperformed the S&P 500 over 15 years. The number that outperformed the market over long run horizons of 30 years or more is staggeringly low. Now, are you likely to be different and beat them? Of course not. Could you get lucky one quarter or maybe 1 year? Absolutely, right? Same for those fund managers. Therefore, instead of rely on luck, take 80% of your equities positions, stick it in low fee index funds or ETFs that track the market indices like S&P 500, for example. And then over the long run, this will outperform your individual bets most of the time after fees. Which brings me to strategy number 5. With the remaining 20% of that money, place high risk, high reward bets. When you're getting started, right, this is where you're going to get the biggest uplift in your portfolio. Now, this strategy is great for accumulating capital and wealth in the beginning. It's not great for preserving capital once you've got it, right? There's a big difference there. So while there's tons of videos on YouTube telling you how to trade crypto or do options or futures or Forex, any number of high risk, high reward assets, I'm not going to focus on what you should specifically invest in because like I said before, winning has a lot more to do with luck than it does really skill. Let me tell you the mistake I made when it comes to high growth investing, which was not placing enough bets. I sunk a huge amount of capital relative to my overall portfolio into specific companies I was convinced at the time were going to be the next big winners. Well, guess what? They weren't. Now, what I learned from studying successful venture capital firms and investors later on was you need to place minimum 20 to 30 bets to have any hope of one of them becoming a home run, right? In fact, that's the model. Lots and lots of bets that won't pay off with 1 or 2 that do. So whatever you plan on allocating to this category, reduce your bet size per company to the absolute minimum you can possibly invest and spread yourself across as many different bets as possible. This way, hopefully, one pays off disproportionately to the others that you lost money on, right? You learn from that, repeat the cycle with the next tranche of capital. Okay, strategy number 6, structuring and taxes. Now, you may not realize, but structuring is actually paramount because if you don't get it right up front, it becomes very costly and complicated later on when you need to make a change after you've made that first batch of money. Now, I said at the beginning of the video that making more income will have a huge impact on your investment returns and overall net worth. Well, saving taxes has the same effect, but in the opposite direction. It massively reduces your costs, and cutting your taxes by 25% legally, of course, could lead to quadrupling your net worth over a decade thanks to the power of compound interest. I recommend spend a lot of time creating the right structure up front. And if you don't get it, ask questions of your accountants or advisors until you do, or frankly, just don't invest in it. Keep exploring options until you find a structure that makes sense to you. Okay, strategy 7, consistency and the power of compounding. Look, consistency beats intensity every time. If you started with 50 grand to invest today and didn't make any top-ups for 10 years, you'll have roughly double your money, 110 grand at 8% compounding interest. Whereas if you invested half that, 25 grand today, and you just topped up 1,000 per month for 10 years, you 10x your original starting capital to 240 grand. So consistency is the name of the game when it comes to success in investing, but also business and in life. Consistent action taking and investing, every spare dollar you have leads to compounded growth over time. Okay, that's it. Here's a bonus tip. Write down your investment thesis at the time of investing. So either when it goes well or badly later, you can refer back to your thinking at the time and look at the evidence you weighted more heavily and the things you missed, and then you can learn from it. Now you might be sitting there asking, yeah, Mike, all sounds great, but what if I lose? Well, truth is when you're starting out, you've got very little to lose and everything to gain, right? People who've made $1 million or more have a lot more to lose. Can you put in place some safety nets? Sure, as you grow, keep a year's worth of living expenses as cash for your disaster fund, right? Which gives you a year to get back on track if you blow up, if you get sick, or if you need to take care of someone in your life. But then you might also be asking, what if I don't have anything to invest to begin with? If you don't have the basics down, like a job or an income or some sort of skill set, then the obvious answer is you should go and get that first. That's it. Hey, thanks for watching. If you want more videos like this, then watch this next one on making money and winning in business and life. And until next time, peace.